Hi friends, I'm here once again to take informed investing decisions. Well, today's topic is actually about marriage of entertainment and entertainment. Yes, you heard that right. The two big players in the multiplex industry are getting married. Well, not literally, but surely, financially and strategically. Inox and PVR, the top two players in the industry, have announced their merger. The merged entity will be known as PVR-INOX Limited. This will be the second biggest merger in the entertainment and media space after the Zee and Sony merger. First, let's understand some of the basic details of this merger, and then we will discuss how this merger will create synergies between the two companies. The merger will be in the form of a share swap agreement where Inox shareholders will receive 3 shares of PVR for every 10 shares of Inox. Post-merger, Inox promoters will have a 16.66% stake, while PVR promoters will have a 10.62% stake in the combined entity. Inox promoters would become the co-promoters of the merged company along with existing promoters of PVR. The merger is likely to take more than 6 months and would be subject to approvals from National Company Law Tribunal, stock exchanges, SEBI and their shareholders. The merger may not require CCI approval, but it has right to raise questions. Having looked at all the basic details, now let us understand how this merger will create synergies for both the companies. We highlight a few. The combined entity will have approximately 40% market share at the box office, which will enable it to gain strong bargaining power against producers, mall owners, advertisers and consumers. The merged entity will operate 1,546 screens across 341 properties in 109 cities. The smaller players like Cinepolis and Carnival are much smaller with fewer screens and weaker markets. The merged entity PVR-INOX Limited will benefit from an increased scale, expanded reach, improved operational efficiency and higher potential for cross-selling. The merger will offer strong revenue and cost synergies and will consolidate the sector with strong growth. In an aftermath of the previous COVID wave, PVR and Inox have seen reopening of multiplexes since Q3 FY22 with a compelling slate of movie releases by Bollywood and Hollywood. Their average ticket prices and food and beverage revenues have almost shot up to pre-COVID levels. Both companies have also seen a rise in footfalls in Q3 FY22 and a 5 times and 6 times increase in revenue in Q3 FY22 respectively on a Q-on-Q basis. While the net debt of PVR decreased Q-on-Q to Rs 8.6 billion, Inox turned net cash positive after the fundraising efforts in June 2021. Although OTT is being considered as a big threat to the multiplexes, we believe that the multiplexes have a better experience in delivering the content, and the combined entity will be better placed to take the OTT competition head-on by improving the experience further. The valuation of both Inox and PVR stands at cheap 12 times and 13 times on an EV by EBITDA basis, making them a good long-term bet. From a technical perspective, an investor with a long-term investment horizon should look at entering Inox Leisure if it breaks out above Rs 460 and PVR if it retraces from the current supply zone, and then one can buy aggressively at Rs 1,785, but the best levels would be at Rs 1,400. This is Viral Shah signing off. Happy investing. Thank you.
This should not be treated as a recommendation. Please conduct your own analysis or consult a financial advisor before investing.
Thank you.